Hello friends, this is a short video on how to trade straddles based on price action. Of course, the age-old conventional method is trading straddles based on Greeks, but we have developed a new method, which of course new in the sense the last 5-6 years, and still a lot of people have many doubts and queries. So I hope this video answers all those queries. And there are some small, just 3-4 rules to be followed while trading straddles. Before that, one needs to know what is a straddle. Straddle is nothing but a call and put of the same strike price of the naturally the same underlying and of the same expiry. And why do people short straddles? Because it is well known that 60 to 70% of the time Nifty is range bound and 30 to 40% of the time it is trending. But what that means is shorting straddles is a non-directional strategy. And where people get stuck is when Nifty starts trending, then they have a problem because they don't know how to come out of it, or they look for adjustments, and in the process of adjustment they don't know what adjustments to do, and then they make a further loss. So the basic thing is identifying that Nifty is range bound. So how to identify that? So let us see some examples. So this is a chart of Nifty in this month of October expiry. So right from 30th September, which was the day one of the October expiry, till today when Nifty expired at 17,730 or so. So fine, it has moved only 730 points in the expiry. It has gone up maybe to 17,800 odd. But if you look at the price action, it was quite volatile, sudden gap ups, gaps down. So if you look at a straddle, like I said, straddle consists of the call and the put. So if you see what happened to the 17,000 call and put, in fact this is a very age-old strategy of shorting at the money straddle on day one of a new expiry. So what happened was, this is a chart which shows the 17,000 call and 17,000 put. The line chart is the green line is the 17,000 call and the red line is the 17,000 put. Right from 30th September, which is over here, the day one of the October expiry, the total was around 730, 740 or so. And today again the total is similar. So if someone had shorted it over here, fine, they would not have made a loss, but they would not have made a profit also. So there was no use of in shorting a straddle and holding it just because Nifty is not doing anything, because the idea behind shorting a straddle is to make profit as well. There is no point in exiting at break even after one full month. And the call moved like this, the put moved like that, and so in between there is a method to this madness. So how to go about that? So explaining some basic rules. So this is the 17,000 straddle from day one of this expiry. This is around 30th September. So this is plotted on a point and figure chart. And why point and figure or even Renko charts are more suitable? Because when a candle straddle is plotted on a candlestick chart, it is not exactly accurate, because if you go into the depth of how a straddle is plotted, it is the call plus put premium at that point of time, and that is the total which is plotted. Every single point is the total of the call and the put. In candlestick it is a bit difficult because there will be a time frame involved, 5 minutes, 15 minutes, and within that 5 minutes what is the high of the call, what is the high of the put, there is always a confusion, and that's why point and figure or Renko charts are more suitable for straddle charts. So this is a straddle chart of 17,000 call and put of the monthly October expiry. So here the basic rule is plot the straddle, plot a triple moving average, that's all, nothing else. So any double bottom cell below the triple moving average of at the money straddle. Now why at the money? Because that is the point where the call and put are closest to each other in terms of premium. If you go higher, the put will be higher. If you go lower, the call will be higher, and there will be a mismatch between the call and put. It might be even 30, 40, 50% difference. So the difference should never be more than 30 to 40% of each other between the call and the put. So at 17,000, at the money was 17,000, and this total was around 730. So this was a double bottom cell which came over here on 30th September itself. And then after that you have to just ride it. And then after that, once again taking a look at Nifty. So from 17,000 Nifty went all the way to 17,400 or so in 3 days. So within that time, what happened to this straddle? For the first couple of days, it was going down for the first 3 days. From 700, it came down all the way to 470 or so. And then here, when Nifty, when this straddle was here, that time Nifty was already near 17,300. So this is the second rule which one needs to follow. As soon as the price of the underlying value of Nifty goes and closes more than 200 points away from the strike price of the straddle, you should cover it. Why? Because there can be a further gap up the next day. What happens if the difference between the strike price and the Nifty goes beyond 200 points? Then the call and put will be very wide apart, and then it is no longer directional. You have to understand this is non-directional. You have to play a range of plus minus 200 points every time. So once it goes to 17,300, naturally the next thing is you have to book profit in 17,000 straddle, and then this is a 17,300 straddle which I have plotted here. Around that same time, this gives a sell over here, around I think 4th October or so. And then this gives a sell here. You have already exited the 17,000 straddle in profit, and then this also gives a good trade over here. Again, over here, what has happened to Nifty? Nifty has come to near 17,500 over here, right? So after that, we plot 17,500 again, straddle, and this is 17,500 straddle. So that will always keep going down. In fact, this is one thing which one must keep in mind. At the money straddle, 95% of the time always drifts down. So this is 17,500 straddle when Nifty was near 17,500, and this also gave a trade over here. After that, what happened was Nifty kept going up, and on Diwali day there was a gap up. But just one day before that, it had closed above 17,650 over here. So then you have to plot 17,700 straddle, and that was over here. So again, this gave a sell near one. Of course, one thing you have to keep in mind is as expiry comes closer, because today is 27th October and Diwali was 24th. So as you come closer to the expiry, which is just 3-4 days away, then naturally the premium will go down, and you don't get that kind of premium. Earlier it was 700 and now it is only 200. But after that, all you have to do is just make sure that there are good anchor columns on the straddle. There is a continuous double bottom sell everywhere, because the idea behind shorting a straddle that it should go down. And when you say go down, that means it needs to keep making lower lows and lower highs. A simple Dow strategy over here, Dow theory. So as long as it is making lower lows and lower highs, you are fine. At the same time, you also need to keep an eye on the triple moving average, because once the trend is in place, when I say trend, I mean a downtrend in this straddle, because everyone knows after 24th October, Nifty was within 100 points of 17,700. It was not much of a trend in the last 3-4 days, and because of that, the straddle kept going down. So once that happens, the triple moving average keeps going down. All three averages are going down together in the same direction. That means the trend is very strong. When I say trend, I am talking about trend of the straddle, not of Nifty. In other words, Nifty is range bound. So as long as the triple moving average is going down, you have nothing to worry. Just identify a previous swing high as the stop loss and exit if it is crossed. So what does observing the triple moving average do? Now, this is a very old theory. In fact, that is true on any candlestick chart or point and figure chart or bar chart. Whenever you have 2 or 3 moving averages, when they are going down or up in the same direction, that means the trend is very strong, uptrend or downtrend. When they come together, that means there is a pause in the trend. And typically what happens is, if you see here, this trend is quite strong, then they appear converging together, and when they converge, when they come very close, in fact sometimes they come like almost like a 45-degree angle, and they become flat. So once that happens, that means a big move is about to come later. That is true on any moving any kind of chart patterns, charting types. So this is where the moving averages went flat, and after that, in fact this was a triple bottom sell here, so that was a very good selling opportunity. Any double bottom sell or a triple bottom sell below the triple moving averages, especially if the triple moving averages are flat, that is the ideal time to enter a straddle, because One is there is a sell signal. Number two, since they were flat, it is going to be a big move. It is going to be extremely rare that it suddenly goes up and takes your stop loss. Because for that to happen, that is another question which people have is what about gap ups and gap downs in Nifty? When you are always short in at the money straddle, you are protected from both sides. The cushioning is from the call premium as well as the put premium. So even if you have a gap up of 200 points, the call will rise but the put will fall. And that's why you need to be in at the money, because initially they are the closest. If you were short in a out of the money straddle, which is let's say 200 points away, or maybe in the money by 200 points, that will affect you very much. So that's why it should always be in at the money straddle. And after that, it is just a question of trailing it. So this month there were only 3-4 trades, 17,000, 17,100, 17,500 and again 17,700, and then all the way to expiry. So it expired at 37, whereas the shorting was near 150. The main point is having patience and having some rules. One is, so the basic rule is plot the triple moving average on the point and figure chart, which is 0.5% box size. Then whenever you get a at the money straddle double bottom sell below the triple moving average, that is a good trigger for entering the trade. And of course, for those who don't know, when you say you shorting a straddle, that means you have to short the call as well as short the put, and that is non-directional. And after that, just trail it. So if Nifty goes beyond 200 points from your strike price, that is the time to exit the straddle short, because that strike price, because then after that you never know, there might be a big gap up or gap down. So summarizing the rules, one is always plot at the money straddle for Nifty. Okay, before that, never try this with Bank Nifty, because Bank Nifty, especially if you are a newcomer, because Bank Nifty can move 1000 points even in 10 minutes. So it becomes very difficult to manage it or even exit. So even on stocks, what happens is sometimes there can be a news or some event in a stock and suddenly there can be a 5% gap up or gap down, and then you are again in a problem. So if you have identified a sideways trend in a stock based on some other chart reading, like a triangle on point and figure charts or some other chart reading, that's fine, but I still would not advise the stock straddles. So Nifty is good enough. Like we saw 4-5 different straddles in the month of October, all gave good results. The key is following the rules, and entry and exit should be as per the rules. There has to be an exit if the chart is giving an exit. So what are the rules? So let me summarize the rules again. Always plot at the money straddle, plot a 0.5% point and figure chart, then plot the triple moving average. Any double bottom or triple bottom sell below the triple moving average, especially after the triple moving average has flattened out and then giving a sell, that is a very reliable sell signal. And then just trail it with the nearest swing high at the stop loss. Now for swing high, you also have mini tops and mini bottoms on point and figure chart, which are nothing but similar to swing highs, swing lows. Or in case there is a big sudden move, maybe even intraday, then there can be a double top buy above the triple moving average. So that is also an exit. A lot of people say that nahi, what wo exit hota hai, lekin wapas it comes to the previous position next day. So what? What if it doesn't? So re-entry is just a brokerage away. What if it gaps up the next day and it goes very much against you? That's why you should always remain in at the money straddle short. And even if it is closing about 200 points or so away from the strike price, you should cover that short and go to the next ATM straddle after plotting the chart of that ATM straddle. If it is not giving a good risk reward ratio, you can wait for the next day. There is no compulsion that you should be always in a trade. You can wait for the next day opening and then take the trade, because who knows, the gap up might be 300 points or there might be a gap down of 300 points. So it's always better to be very much in the at the money straddle, and if it is closing very much away from your strike price, then exit it. If the new straddle, fresh ATM straddle is giving a good structure for selling like this, then you can enter. If it is not, better to wait for the next day. And then after that, it is just a game of patience, trailing it till as far as you can, because like I said, this gives a cushion of almost 150 to 200 points lower and 150 to 200 points higher, which means about 300 to 400 points on total range of Nifty. So especially when Nifty is within that range, maybe for 5-6 days or maybe even 10 days sometimes, that really helps you, and this straddle melts very fast. So once you follow these rules, these are good enough to be in a trade maybe even 75% of the time in a month. What happens is, if in any given month Nifty is trending, you are never caught on the wrong foot. In fact, at recently concluded DECMA, I had shown something similar where Nifty had gone up by 1500 points in the month of August, and that time I had shown how it gave exits, and it should have exited in the first place, because what happens is, let's say Nifty makes a move of 1500 points. For example, assume that we had closed at 18,500 today from 17,000. That 17,000 straddle would have been 1500, and you had shorted it at 750. So there was no way you could have made any money. Of course, then the question of adjustments and other things comes into picture. Again, that is something which you need to be expert in. If you are not, then better to follow the entry and exit rules like I have mentioned. And even if there is a stop loss, it won't be a very big stop loss, and it's as simple as that. So once you follow the rules, it is not very difficult. Maybe you need to get used to following the rules and observing the charts. But again, like any other trading strategy, it is quite easier said than done. So you need to get used to it, and hope you enjoyed this video, and do subscribe to our channel, like it, and share it. And thank you for watching this. Thank you.